The AI market continues to dominate. We continue to get earnings, kind of solidifying that the AI market is real. We're going to continue to see massive and massive investments in this space. Now, on today's episode, what I want to do is take a closer look at three AI stocks that I believe are extremely bullish for the long term of things. And looking at this slideshow really quick here, we can see that there are data research groups that believe the capex and the capital expenditure of data centers will reach $1 trillion by 2028, thanks to companies like Amazon, Microsoft, OpenAI, Tesla, Apple, and the list goes on and on. So now that we know that this market is expected to hit $1 trillion spending by the next few years, the three companies that I want to focus are pretty much engraved in that space. We're going to look at one company that's extremely strong in the data center market, a company that's crucial for AI chip development, and a company that is growing thanks to AI software. So all of these can see that massive tailwind from the AI space. So let's take a closer look in today's episode. All right, so the first company we're going to start off with is Alphabet, aka Google. This is one of those stocks I am actually very, very, very bullish on, especially for the AI race. In forms of the data center, in forms of the AI, they pretty much have it all. They have the infrastructure, they have their own ASIC solutions, their own chips, they have their own data, they have their own massive consumer platforms to send out plenty and plenty of products to the consumer. So they are in the right spot at the right time with the right products and the right assets to be able to win this AI race. So for those that are not familiar with Google, this is the massive company, or aka Alphabet. This is the massive company that owns YouTube, Android, Google Cloud, other bets like Waymo, Robotaxis, and Verleaf, which is their life science. Now, most of their money does come from the advertisement space, but Google Cloud in 2024 was roughly 12% of total revenue, kind of pushing into this most recent quarter. This most recent quarter revenue from Google Cloud, which is going to continue to grow with AI infrastructure, has jumped to about 14.5, almost 15%. Next, I want to take a closer look at some of the financials, right? And this is where I'm partnered with an amazing company, Fiscal.ai. We're going to see a lot of great charts here. And if you are serious about investing, definitely check out Fiscal.ai/Jose for a special offer. I'm focused pretty much in the AI and semiconductor market, and this is a platform I use on a daily basis. But kind of with their most recent earnings that happened just a few days ago, we can see total revenues continues to grow. Gross profit margins continue to grow. Net income continues to grow, even though there is this scary story that the AI market is going to somehow destroy Alphabet's business. At the moment, we see that that is not true. Now, we also see this company has plenty of cash and short-term investments, almost $100 billion there. They have a free cash flow of $66 billion the last trailing 12 months and long-term debt of only about $23.6 billion. So financially, they can withstand any trouble if that comes out as well. Now, what gets me pretty excited about Google, and like I mentioned, they have all these great products. They have the data from all the search engines, from all the YouTube and all these other platforms. They have the infrastructure. They built their own AI. They have the Google Cloud, and they have kind of their own AI chips to help benefit that as well. Not only that, they also have kind of their own Gemini solution, which I personally use Gemini now on a daily basis. Now, if we look at forward PE ratios, the median is roughly 19.57. Right now, it's 19.47. So it's pretty much on par with median. And this was for the past 2 to 3 years. This tells me that the market is not, Google's not overvalued at the moment, right? It's perfectly valued, but these valuations are actually way cheaper than the rest of the Max 7. Just alone, multiple expansion could be a great reason for the stock to continue to get higher and higher. And that multiple expansion can grow and grow as we see that Google Cloud business continue to grow as well. So I think valuation is pretty strong here. Now, in forms of low-hanging fruit, what is the easiest way this company can kind of just grow in general? First, it's just, in my opinion, profit expansion. Google Cloud is becoming more profitable as AI workloads, things like Gemini, Vertex, and TPU scale. That alone can help this company become even a bigger position. Obviously, higher average revenue per user when you're bundling things like YouTube Premium, Music, Gemini, AI add-ons into super subs. Finally, if the AI market continues to push, demand allows for cloud to not only expand profits, but start to grab market share. And as you start to grab more market share from other players like Amazon, like Microsoft, this is going to become a company that you're going to see valuation multiples expand dramatically. I mean, just giving this a median of around 25 is still cheaper than most of the Max 7. So for me, Alphabet is obviously there's no guarantee in the market, but the closest thing, in my opinion, obviously there's always risk, is Google for sure. I mean, some of the moonshot upsides they have are things like Waymo, right? Waymo is growing dramatically. They're expanding into various cities all over the world, and they have the potential to be an AI winner with Gemini, which drives more demand for their cloud solutions, which is becoming even more profitable. And this scenario is possible due to its ecosystem of data collection, which I've talked about in the past. Now, the biggest bearish thesis here is obviously the AI market eating up the ad story, the search story. But we're already what, a year and 2 years ahead here, and we haven't seen that just yet. When will this bearish thesis happen? The second thing is kind of the antitrust issues that overhang Google in forms of maybe having a monopoly, of splitting some of the businesses, some of the issues in Europe, and the list goes on and on. But I believe most Max 7s are going to face very similar bearish issues in the future. And that's why for me, I really wouldn't put too much fear in that bearish case. So that's stock number one. Now, if you are enjoying the episode, I'm trying to hit 75,000 subs by the end of the year. So make sure to hit the thumbs up and subscribe button. I do have a free semiconductor AI newsletter, whatthechip.happened.com. Now, stock number two is ASML Holdings. So for those that are not familiar, this is a big semiconductor equipment player. And I am a big semiconductor guy. Now, what does ASML do? They make DUV and EUV photolithography machines. And these are machines that are crucial for a special process in chip manufacturing. It's not the only machine, right? It's not the only machine needed, but it is crucial. Now, how they make money, very simple. The upfront hardware sales fund research and development, and their expanding install base. Their equipment sells for hundreds of millions of dollars plus. And those installed base generate kind of a annuity-like installed base model cash flow that smooths the semiconductor equipment cycle. Because this is a cycle that you don't buy a new equipment every day or every quarter or every year. Some cycles might be a little bit slower. But if you have kind of this subscription service of maintenance, you're able to maintain revenue and cash flow even during bad times. Now, the first thing I want to kind of showcase is net bookings and service and field option revenue, which is kind of that maintenance revenue. Service revenue has grown dramatically, continues to grow. And that's super amazing because it allows you to have strong amount of revenue coming in even during a downturn. Now, net bookings, you want this to continue to grow, but right now there is kind of a down cycle happening in the equipment space, and that's why we see kind of a pullback. But the great thing, it seems like maybe that pullback has kind of bottomed, and now we're just expecting that turnaround story. Now, in forms of balance sheets, this is a company that has done really well at total cash and short-term investments of roughly $7.2 billion. They have only $3.7 billion in long-term debt, and look at that free cash flow of roughly $9.2 billion. So free cash flow, plenty of cash, and not a lot of debt. This is a company that I have no worries about financially. Now, what's even more important is the valuation, right? If we look at forward PE values of this company, is right now sitting at 26.25, where the median is 29.4. So it is trading way below that median. And this is going back since 2016, almost a decade, right? About 9 years. And it tells me that the market has a lot of fear for ASML, even though this company does still expect a lot of growth. Now, we'll talk about the risk, but in my opinion, the risk for this company is something that might continue for the next few quarters, but the long-term opportunity is very, very high. Now, the low-hanging fruit, what is the easiest way for ASML to make money or to increase kind of revenues in the short term of things? First is that service and upgrades. Every new lithography machine that ships with multi-year service contracts. And older machines need productivity upgrades. So you always have that business continue to grow and grow and grow as you ship out more systems. So that's an easy way to upsell your product and get better margins and get consistent revenue. The second is right now in the memory space, thanks to things like HBM, it's creating this need for lithography machines as they need to kind of find ways to improve margins. So you're seeing companies like Samsung, SK Hynix, like Micron, restarting growth in capital expenditure, which is extremely bullish for some of the lithography products that ASML provides. So those are two markets that are just growing like that right now that can definitely be the low-hanging fruit for this company. Now, there are the moonshot upsides, which is what is going to drive this stock to a lot higher price in the future. First, ASML believes that this market can grow to about 44 to 60 billion euros by the end of 2030, led by the increased amounts of chips needed for the AI, for edge, for electrification, the EV space, all types of energy, and Internet of Things generated data. And obviously, if you are big in the AI space, you can potentially see the huge demand of AI compute continue to grow. And that's one of the moonshot theories here for ASML. The second is they continue to develop great platforms that, in theory, eliminate some of the processes needed to manufacture certain chips, which could help customers save money. Now, I think the market is very worried about the bearish thesis. The first is geopolitical and export controls. In December of 2024, the US rule widens China restrictions to some DUV. So you can't send the best equipment to China. And that is impacting some revenue. They actually had to write off some backlog in this quarter, which kind of caused some negative pressure. The second thing is this company is very cyclical, right? They're only cyclicality and customer concentrations kind of go hand to hand. They only have pretty much like three major customers: Intel, TSMC, Samsung. And if any of them decide, you know what, maybe I can wait a few quarters before purchasing a new machine, it can completely mess with revenue, with bookings, and a lot of the financials, and make things look pretty scary in the short term of things. I think the market only looks at the short term of things, but I do believe the long-term opportunity is pretty much there, especially as we're seeing manufacturing fabs, especially by TSMC, the leader, being built all over the world. Now, number three is going to be the AI software stock. Now, this is going to be GitLab. This is one that I'm very bullish on. It is my biggest non-semiconductor position in my overall portfolio. You might be curious. They'll say, what do they do? So they do kind of end-to-end DevSecOps, which is pretty much a SaaS platform where you do them for repo, for continuous iteration and development of a software. They do security, they do deployments. And pretty much what happens here is when you develop a form of software, there's so much that needs to go, right? It's not just coding. There's so many things in between developing the code, making sure the code works, once the code is running, making sure there's no errors, making sure what are the analytics behind it, develop it some more, fix some issues, patch it up, continue to run the system, have security issues checked out, have analytics here. So that's pretty much what GitLab does. It has kind of this full-on suite. It's a single application. And the overall pitch is it lowers the total cost and higher velocity versus kind of stitching together a lot of solutions. For example, what GitLab does, you can do with like GitHubs plus Jenkins plus Jira plus point of security tools. So instead of doing all that and kind of having all these different applications and licenses, just go with one product, GitLab. Now, how they make money? Very easy. They have a seat and usage-based subscription. You have the free, the premium, the ultimate. And outside of that, they also have even more add-ons that you can add with each subscription as well if you want kind of extra services. Now, if we look at operating revenues in the last trailing 12 months, it continues to grow, right? That's super bullish. You continue to see quarter over quarter basis. Net income is now also profitable after being kind of negative for the past few years. Outside of that, gross profit margin still stands at a very healthy 88.64%. Now, in forms of total cash and short-term investments, over $1 billion, pretty much flat in free cash flow at the moment. A decent stock-based compensation. I do want to say that's the bearish thing, but no debt is what I wanted to say. So very, very healthy balance sheet for a company that can continue to grow dramatically. Now, I wanted to kind of look at GitLab's forward price to sales ratio. right now is sitting about 8. The min in the past 2.5 years was roughly 6.8. So we're not too far from that min. The median is around 10.83. So we are very much undervalued here. And the max is roughly 16.82. Again, all these charts, you can get them pretty easily using fiscal.ai/OZ. Now, the low hanging fruit here, the easiest way GitLab can grow revenue is seat expansion inside existing logos. They have over a 120% net retention rate, which shows room for them to continue to expand there. Premium prices hike in 2023 demonstrated pricing power. They are adding a lot of AI monetization tools, and you can kind of attach Duo to some of the upsell motions there to grab even more revenue. In May of 2025, they had FedRAMP moderate, which authorized them to sell certain products to the US federal and the state contracts. And there are reports that that's in early pipeline building today. So I do believe there's a lot of low hanging fruits for this company to benefit dramatically. Now, the moonshot upside and the bearish thesis, the bearish thesis, let's talk about it. There's a lot of competition. Companies like GitHub bundles Copilots in cheaper tiers, and you have kind of other competitors, players entering into this market. The big thing, though, is this is a company that does it all. It has a full suite where you don't have to download or have all these different applications. That is a huge benefit, in my opinion. But the market, if I talk to most people about GitLab, they're going to say, yeah, but you have Cursor out there doing some form of AI IDE or AI coding solution. You have all Windsurf and all this. All those are just a subsection of what GitLab does, but the market doesn't understand that. And that creates kind of this bearish thesis on the stock price. I do believe eventually this one will show its roots. And with a market cap, I think less than $10 billion, this could be a multi-bagger in my opinion. Obviously, never a guarantee, but it does have the attributes to make that happen. Share-based compensation was still pretty high, almost a quarter of total revenue. The bull side is enterprises consolidate fractured tool chains into a single platform like GitLab, which can triple GitLab's seat count. And then you can even sell even more products within there and upsell, which I do believe is very, very exciting. And I think that's going to happen. I am very bullish with this company. I believe there is potential for this one to be a massive winner. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you all next time.